I think we're going to continue to go up. I think it's playing for a variety of reasons. One is the tremendous amount of cash that's still in the market that's created by the central banks of the world. They've created about $21 trillion in cash. That equates to the entire GDP of the United States. That money is still out there, even though the Fed has cut back a little. And two, I think the issue is there's some looming dangers, in my opinion, in Europe. So we're seeing money shift out of Europe and also come to the United States. And the other issue, I think, is the trade skirmish, if you want to call it, with China. The issue there is that, well, yes, China's the second largest economy in the world. Our economy is GDP is 21 trillion. Their economy is 13 trillion. So if this continues, in my view, China is going to take the hit. It's not going to be the United States.
So based on that assessment, if trade has been the one issue that's really been impacting people's minds when it comes to where stocks are headed, based on that assessment, do you think stocks are undervalued, fairly priced, overpriced?
I think they're slightly undervalued at this point. I think the emphasis on the trade, what people call trade war, I call it trade skirmish, I think was overdone. Yes, we had some days where the market was moving and, you know, the press was saying, well, this is what's causing the movements. But on any kind of medium term, much less longer term basis, the United States is able to deal with this in a relatively calm way, while China could get significantly hurt by this if it continues. But I do, to go back to an earlier comment by Joe, think that the Trump administration is negotiating, and this is the way they negotiate, and they ask for more than they want, then they have a fallback position. I think this all gets eventually resolved.
So you think Treasury yields are headed higher, stocks should be headed higher. You do have some concerns when it comes to Europe, though. I saw a note you put out recently where you said nobody is paying enough attention to Italy. That's correct.
The Italians, it's a coalition between the Five-Star League and the Northern League, and if they keep their word to the people in terms of the programs that they were going to put in place when they were elected, they will far exceed the EU budgetary rule of 3%. If they don't keep their word, I think they're going to find themselves in trouble with their own citizens. All this comes out, so you know there's a timeline here. They're supposed to be out with their budget by September 27th, next week. Mm-hmm. The EU is supposed to approve it by October the 5th. So we've got a short timeline, and we could see some real upheavals depending upon what the Italian government does.
What does that mean for investors?
I have been advising people and institutions to stay out of Italy and, frankly, to stay out of investing in Europe at the moment until we get some more clarity. The other issue I'd like to address, Becky, is what you just raised, which is interest rates. I find it very difficult to comprehend why the Fed is behaving the way they are. The U.S. government, Congress, the Senate, everybody's trying to grow the economy as much as possible, and they're being successful in doing that, which is great. And the Fed keeps wanting to raise interest rates to go back to some sort of normality that hasn't existed in a decade. And I think it's absolutely the wrong move on the part of the Fed.
Why? If you're not going to raise rates now in a great economy, when are you going to do it?
Well, you don't need to do it necessarily, Becky, at all. There's no, you have to raise in a great economy. Why do we need to raise rates at all? Why can't we even increase the economy further with low interest rates, lower mortgage costs, lower borrowings? What's the point?